Oh, didn't see you there. Thanks for tuning in, guys. Got an amazing video for you today. Now, we talk a lot on this channel and in a lot of my courses about options. And specifically, options, again, are an agreement to buy or sell a certain amount of stock, 100 shares per every single option at a predetermined price at a predetermined date. Now, part of that is a predetermined date, right? A predetermined date is when the option expires. Now, a lot of people have been hitting me up. They're saying, Steven, we talk a lot about this predetermined date with options, right? And how they expire. Now, what happens when they expire? Well, they settle, right? They settle. And depending on what stock you're trading, they might settle a little bit differently. Now, the interesting thing about this is, depending on the stock that you're trading, you could have a massive tax advantage. That's right, a tax advantage just by choosing the right underlyings and the right stocks to have your options settle at. So I'm going to open up this computer, I'm going to click little buttons, I'm going to pull up the slideshow, and we're going to talk about how there is a big tax advantage depending on how your options settle. I'll see you guys inside this thing, inside my MacBook, inside this computer. Okay, ladies and gentlemen, boys and girls, my name is Stephen Brooks. Welcome to my computer. Stock versus cash settled options. So again, as I mentioned in my intro, a lot of people have been hitting me up. They're saying, Steven, we talk a lot about options, how there's some sort of an agreement to do something at a predetermined date. Now, when that predetermined date happens, well, what actually goes on with the options? You know, if they disappear, if you can't trade them anymore, if they expire, what actually goes on? Well, it's very, very interesting, right, to see what happens on settlement when things settle. And specifically, one of these, stock or cash settlement, has ginormous tax advantages that we'll get to here in a little bit. So if you have the ability to trade the types of stocks that give you that huge tax advantage, they could be really game changing for you guys, up to a 20% savings on your taxes from your profits and your investments, just by using the right kind of stocks. Pretty cool. And you'd be smiling too if you had an investing game plan. You know, this is something I've enjoyed the fruits of for sure over the last couple of years. And after watching this video in the next couple minutes, you guys will be able to know this too. So here we go, guys. And this isn't going to be a huge long one, but this is going to be able to save you a ton of money on your taxes if you know what you're doing. So, settled options, right? A lot of people have been asking me what happens. So again, options, they're contracts / agreements to buy or sell 100 shares of stock for every option we have at a predetermined price, which is the strike price, at a predetermined date, which is their expiration date. So a lot of people saying, Steven, after that expiration date, on that predetermined date, you know, what happens to the options? You know, what happens depending on where the strike price, that predetermined price, is compared to the price of the stock on expiration on that predetermined date? What happens when this contract actually goes into effect? Remember, because an option is a contract. It's an agreement. What happens when this agreement actually goes into effect at this predetermined date? Well, the options settle, right? They say settle. That's the term that's used. They settle. So settling the stock, all equity options, when they expire in the money, meaning the price of the stock is greater than your call, than the price of your call, or the price of the put is below. So let's go through that really quickly. And we're going to have a lot more content. We're going to have a ton more content that I'll link in the description that talks about what in the money means. But what we're talking about here is all equity options, when they expire in the money, expire to stock. So if we were holding, if we are holding, let's say, in Facebook right now, the 280 call in Facebook, right? That is in the money because the price of the stock, 180.18, is greater than the strike price of my call, 180. So if we have an in the money call, like the example of owning the 180 put at expiration, right? 100 shares of stock is given to me per every option that I own. If it's in the money, if it's not in the money, I get nothing. On the put side, if I own the 185 put at expiration in 5 days, the 185 put is above the price of the stock, or the price of the stock is below the price of my in-the-money put. Thus, I will be short 100 shares of Facebook. Don't worry, I'll link in the description. We have other videos about that, so don't worry about in the money, out of the money, any of that stuff, right? Just know that if it's in the money, right, all stocks settle to, all options settle to stock. Another way of saying that, and you'll see why here in a little bit, all stock that has volume, all of those options settle to stock. All right, so after this expiration period, and if you have an in-the-money option, which we just showed you, again, don't worry, I'll link in the description all the other videos we have about that. You will have either long or short 100 shares of stock in your account that you are now the proud owner of. Congratulations. Now, settling to cash. This is where it gets kind of interesting. Indexes in the VIX, they settle to cash as there is no stock to trade. So if we look at Facebook, Facebook had 28.5 million shares traded on Friday. Right? Because of that, because there was any stock volume, we know that all options settle to stock. SPY at 144 million shares traded. All options settle to stock here. Let's see Apple. Apple had 40 million shares traded on a given day. 40 million shares traded on a given day. All of its options, when they expire, they settle to stock. Now the VIX does not have any volume. So there's no stock to settle to. In this case, the VIX will settle to cash. So rather than you getting 100 shares of stock, right, the amount of money you made or lost will just be debited or credited to your account in the form of cash. The SPX is the S&P 500 index. There is no stock to trade here. So everything settles to cash. We have the RUT, which is the Russell 2000. There is no stock to trade here. Thus, all options settle to cash. We also have the NDX. This is the NASDAQ 100. If you're trading this, there is no stock to trade, zero volume. Thus, options do not settle to stock. They settle to cash, right? Same thing with the DJX. This is the Dow, right? The Dow, no stock to trade, guys. There's no stock to trade. Now, as you know, if there's no stock to trade, everything settles to cash. So when you have volume, if there's any stock volume, all of its options will settle to stock. If you have some sort of an equity index or the VIX, all options will settle to cash because there is no stock to settle to. So if you're holding an in-the-money option at expiration, the cash you make or lose will be credited or debited from your account when those options expire. So if you have a losing in-the-money option in something that it expires to cash or settles to cash, meaning there's no stock to trade. If you have an in-the-money option that is a loss, they will literally take the money straight from your account. If you had made money on the in-the-money option, that is for a cash settled product, such as the S&P 500 index or the VIX, where there's no stock to trade, they will credit your account with the money you've made. So in this situation, you don't have to worry about being assigned stock. Remember, if you have an in-the-money option, you will be assigned stock for a stock that has volume. So again, if you have an in-the-money option, don't worry too much about it now. In Facebook, you will be assigned stock. But if you have an in-the-money option for VIX, the money will just be taken out of your account if you're a loss, or will be given to your account if you're a winner, right? And one of the values of settling the cash is you don't have to worry about margin requirements increasing after assignment. If you own, let's see, in Facebook, if you own a 180 call, right now that's only costing you about $1.59, so $1.59. However, because every single option is worth 100 shares of stock, if this is an in-the-money option, which again, the price of the stock is above the price of the call is 180, the price of the stock is 180.18, Right? So right now, this is only costing you $159 to own. But if this becomes in the money and you are assigned 100 shares of stock, because the options in Facebook, which has volume, settle to stock, rather than only putting up $159 of margin requirement, you're going to have to put up 100 shares worth. So 118 times 100, you're going to have to put up almost 18. You're going to have to put up $18,000 of margin requirements. So while settling to stock is good sometimes, the margin requirements typically get a little bit larger. That's one of the benefits of cash settlement. However, there is a huge benefit to cash settlement, and this is pretty amazing. And full disclosure, I fully take advantage of this. It's my legal right to do this. I fully take advantage of the cash settlement and the tax benefits that come with it, right? So while cash settlement index are not only cash settled securities, they do come again with a huge tax advantage, right? So in cash settled indexes, right, the VIX does not have any stock. Thus, everything settles to cash, right? There's a tax advantage to trading the VIX. The SPX, all of its options, the S&P 500 index, settle to cash. There's no stock volume. Thus, there's a big tax benefit for doing so. The DJX, the Dow Jones Industrial Average Index, there is no stock volume. Thus, all of its options settle to cash. And when they settle to cash, there's a big tax advantage. So all profits made in these cash settled indexes, so where you have options and the options expire to cash, not stock, all profits are taxed at 60% long-term capital gains and 40% short-term gains. So the first 60% of the profits that you make trading options in cash settled indexes, which are those stocks that do not have any stock volume, the first 60% of profits, whether you hold them for a year or 2 minutes, are taxed at long-term capital gains. So if you have a tax rate between 25 and 35%, your long-term capital gains are taxed around 15%. If you are at the high end of the tax bracket, the 39.6% tax, your long-term capital gains are taxed at 20%. But either way, there's a big advantage, and we'll get into exactly what those numbers look like. Right? And then the second 40 are taxed as normal short-term gains. So even if you make money in an options trade in a cash settled index that lasts 5 minutes, 60% of those profits will be taxed at long-term capital gains. And this is what that kind of looks like, which is really big. So again, if you pay a 25% tax rate, your long-term capital gains rate is 15%. So if you hold a stock for a year, those profits will be taxed at 15% instead of 25%. However, if you trade in one of these indexes that does not have any stock to buy or sell, which means rather than having its options settle to stock, they settle to cash. If you trade those for 5 minutes, 60% of those profits are taxed at 15% or long-term capital gains, and only 40% will be taxed at 25% rate. And if you hold those for a year, everything will be taxed at 15%. So for those that pay a 25% tax, and if they make profits in a cash settled index, which again is like DJX, there's no volume. There's no volume, guys, no volume, which means all of these options in here, all of these options will settle to cash, right? If you have a 25% tax rate normally, that's an 8% savings on your tax bill. That's an 8% savings on your tax bill. And then if you're someone like me at the very high end of the range in terms of the tax rate we pay, a 39.6% tax rate, the first 60% of those profits are going to be taxed at 20%. And the 40% remaining are going to be taxed at 39.6%. And that's a big percentage when it comes to the savings on my tax bill. That's a 19.47% difference. So if I make $100,000, if I make $100,000 over the course of the year trading options in one of these cash settled index, like the NDX, again, the NDX is the NASDAQ index. There's no volume. And if there's no volume, there's no If there's no volume, there's no cash. 2, there's no stock to settle to, which means everything has to settle directly to cash, right? The first 60%, of that $100,000 I made, the first 60% of that are taxed at 20%. The remaining 40% of that $100,000 are taxed at 39.6%. So, if I just traded stock, right? If I just traded options that are settled to stock that have volume, like something like Twitter, something like Facebook, you can see they all have volume. Something like Netflix, they all have volume. All these options settled to stock. If I made $100,000 trading Netflix, I would only make $60,000, $400 after taxes. However, if I made those same exact trades, but in a cash settled index and I made $100,000, I walk away with almost $12,000 more because I have a 19.47% savings on my tax bill, because the first 60% of those are taxed at my long-term capital gains rate, and only my additional 40% are taxed at my normal rate. And that's absolutely crazy, guys. That's a really, really big thing. That's a huge thing, especially when you think of the year after year after year after year after year of 20% savings on my taxes just by using the right stocks. So what are the takeaways here? Any stock that has stock to trade, its options settle to stock. Netflix, let's say Amazon, stock to trade. Every option in Amazon settles to stock. Google, stocks, there's volume, right? There's volume, which means every single option in Google will settle to stock. Let's see, Alibaba, every single option in Alibaba will settle to stock. But then we have the SPX. There's no volume, which means everything has to be settled to cash. And this is where the tax advantage comes in. NDX, this is where the tax advantage comes in again. There's a lot of options here, as you guys can see. There's a ton of options, as you guys can see, but there's no stock volume, which means everything here settles to cash. And there's a big tax advantage to that. The RUT, the same thing. No volume, all these options, they all settle to cash. The VIX, same thing. No volume, no stock to trade. That means that every single option here, all of these VIX options will settle to cash, which means the first 60% of all of my profits, whether I hold them for 2 minutes or I hold them for 364 days, the first 60% of those will be taxed at my long-term capital gains rate, and the additional 40% will be taxed at my normal short-term income rate, right? So that's a huge, huge, huge tax advantage. And as you guys remember, for those in the 25% tax bracket, that's still an 8% savings on your taxes. But those at the very high end of the tax range, that's a huge saving. That's almost 20% savings on your taxes. So any stock that has stock to trade, its options settle to stock. All stocks without stock to trade or no volume, its options settle to cash. Right? So there's a big tax advantage to trading cash-settled indexes, which 60% of gains are taxed at long-term capital gains rates, even if you hold them for 2 minutes, and the remaining 40 are taxed at short-term rates. Right? So for those that have a 25% tax rate, these indexes with no stock to trade, thus they're cash settled, create an 8% saving on taxes. And for those at the very high end of the tax rate, like myself, 39.6%, cash settled indexes, those without any volume, no stock to trade, that are cash settled, created 19.4% savings on our taxes. So I'll give you one right here, right now, that you should be doing. DIA. These are called the diamonds. This is the Dow Jones Industrial Average ETF. Right? There is volume here. There is almost 6 million shares traded on Friday. As of writing this, I'm recording this on a Sunday. Right? On last Friday, there were 5.8 million shares traded. How many options were traded? There were about 53,000 options. So every single one of these options that was traded at some point, if we're still holding them at expiration, are going to settle to stock one way or another. Right? Every single one of those profits are going to be taxed at short-term rates. However, DJX, which is what we looked at, is the exact same price as the diamonds. There's no volume. This is an index. So immediately off the bat, we see all of these options. We see all of these options that we can trade. And all profits from this, there's a big tax advantage, right? So where everyone thought to trade DIA, because DIA is known, is heard of, well, you could trade something that is the exact same price, that does the exact same thing, but you can have somewhere between an 8 to 20% tax advantage on all your profits. And I don't know about you, but every single penny I can make, that's what I'm in for. So that's a quick one. Remember, guys, DIA, this is a stock. This is a stock with volume, which means all of these options, every single one of these options will settle to stock. However, DJX, which is just the Dow Jones Industrial Average Index, has still all these options, but there's no volume because there's no stock to trade. So every single option here that has to get settled or exercised at expiration, all of those gains will be a huge tax advantage. The first 60% will be taxed at long-term rates and the second 40% at normal rates. And again, if you're at around a 25% tax rate, that's an 8% savings. And if you're at the very high end of the tax rate at 39.6, that's about a 19.47 or 20% savings on your taxes. Again, guys, all these things add up big time. So this was kind of a fun one. I'm sure it's something that you had never heard before. It's something that I've been fortunate enough to know and be able to take advantage of for many years. And over those years, I've had a tax advantage, a legal tax advantage, just by making a choice to trade a certain type of product. So the example I showed you, DIA, the diamonds, this is the index ETF for the Dow Jones Industrial Average, right? They're stock to trade. If they're stock to trade, that means all options for that stock will settle to stock. Every single profit that I make in those options will be taxed at my short-term rate, which is 39.6%. However, if I just make the choice to trade something like DJX, which is the Dow Jones Index, there's no volume, there's no shares, which means there's no stock to trade. And if there's no stock to trade, all options in that index will settle to cash. And if they settle to cash, I have a huge tax advantage. The first 60% of my profits will be taxed at my long-term rate of 20%, and the second 40% of my profits will be taxed at my short-term rate of 39.4%, or 6%, which means I'll have a 20% savings, on my tax return. So, for you guys, what's the takeaway? If you're interested in trading options in DIA, scratch that. Trade options in DJX and save on your taxes. I'll see you guys in the next video.